Alright, traders, buckle up, because the market just pulled off a magic trick last week. The US government literally shut down, and yet stocks hit record highs. This week, we're breaking down what's driving that upside, how the Fed's next move could light a fire under equities, and two names I will be sharing with you that are flashing strong bullish momentum signals. Let's get into it. Here's the deal. Despite political chaos, Wall Street just doesn't care. Because the S&P 500 climbed to new all-time highs, opening at 664 and closing just above 669 last Friday. Optimism around Fed rate cuts kept the market grinding higher all week. The Nasdaq also notched fresh records, closing near 603, even though megacaps like Apple and Nvidia saw some midweek chop, but cyclicals and AI-driven tech picked up the slack. Meanwhile, small caps were the real winners, up the strongest percentage-wise 1.86%, while the Dow joined the all-time high club too, closing just under 468 on Friday. So what powered this resilience? Three things. First, the government shutdown. Yeah, it finally happened. The first in 7 years. But instead of panic, markets shrugged it off, seeing it as a reason for the Fed to stay dovish. Second, rate cut expectations. After weak services and jobs data, traders are now pricing a 92% chance of an October rate cut. That's basically a done deal, according to CME FedWatch. Third, the divergence in data. The ADP report showed 32,000 job losses, totally unexpected, while inflation, via PCE, stayed in line. That's a classic bad news is good news setup for markets banking on easier policy. And here's the kicker. Gold hit $3,896 an ounce, the highest ever. Safe haven demand is quietly surging even as equities run hot, and gold is still going. The VIX ticked up to around 17. Not panic levels, but showing that under the surface, traders are getting cautious. Yields eased too. The 10-year Treasury slid to 4.12% as money rotated back into bonds. So yeah, the market's basically saying, cut rates already. Now, looking ahead, buckle in, because next week's packed. The Fed minutes and Jay Powell's remarks will be parsed for every nuance on rate timing. Plus, unemployment claims will come in, if the shutdown doesn't interfere. And Thursday brings the earnings kickoff with Delta and Pepsi reporting pre-market. Meanwhile, the Battery Show and EV Tech Expo in Detroit is happening, plus Amazon Prime Days will give us a sense on retail and consumer spending trends, and the ongoing shutdown negotiations will add extra fuel to the tape. Now, let's talk about opportunities. This week, I'm watching two bullish setups that are building serious steam. Alright, let's start with the first one. Western Digital ticker symbol WDC. After months of upside, it exploded even higher after multiple analyst upgrades citing a surge in AI-driven demand for cloud storage and hard drives. The story here? Simple. Every AI model needs mountains of data storage. That means massive orders for HDDs and NAND drives. This company sits right in the middle of that supply chain. Data backs it up. Unusual volume, sustained buy-side flows, and options traders loading up on near-term calls. The sentiment's clearly bullish. The chart confirms it. If you're trading it, I'd look for the pullback into 125 that will happen this week, hopefully for entries, with a 123 stop loss. This is not financial advice. My approach? Defined risk setups, 1-to-3 risk-reward ratio, targeting continuation. This isn't hype. This is structure plus momentum. Next up, Coinbase ticker symbol COIN, another name riding a comeback wave. Bitcoin's reclaimed key support levels, and sentiment across crypto is improving fast. Add to that, SEC Commissioner Hester Peirce publicly called for more regulatory clarity, and suddenly, investors are feeling optimistic again. Coinbase stock jumped nearly 22% last week, riding the Bitcoin rebound and heavy call option activity. The short-term call skew is rising. That's traders betting on upside moves in the next couple of expirations. Technically, it's a pure breakout play after months of trading sideways between $293 and $340, and today it reached $392. If it can stay above those moving averages, this thing's got room to run. For entries, I like waiting for minor pullbacks to short-term support around 370, with a stop loss at 367. Then I can play some defined risk call positions. This is not financial advice. Just what I'm watching. Most importantly, try not to chase. But I honestly still can't help it sometimes. After 10 years of trading and I still chase more often than not, it is what it is. So remember, volatility is your friend if you manage it right. Now, a few tactical reminders before you hit buy. Avoid big naked directional bets during Fed speaking events. That's when headlines whip the tape around. Watch the VIX. If it spikes above 18, that often signals a sentiment shift or potential short-term reversal. Keep an eye on 10-year yields. Intraday moves of 10 to 15 basis points can trigger sudden rotations between growth and value sectors. Stay alert, stay nimble, and size your trades with precision. Now let's talk about what I'm avoiding this week, and it's not a specific ticker, it's two whole sectors flashing yellow: regional banks and energy. Regional banks are staring down credit risk and local lending pressure thanks to the government shutdown and softer job data. Even if rate cuts are coming, those benefits won't kick in fast enough for small lenders feeling the squeeze. And energy. That's the weakest S&P sector right now, down nearly 2% on September the 29th alone. The strong dollar and slowing global demand are squeezing oil prices. That is bad news for energy bulls. So while the rest of the market's charging higher, I'm steering clear of those corners for now. All right, to wrap it up, the market's still defying gravity. The Fed's in the spotlight, gold screaming caution, and momentum's alive in selective plays. My top bullish watches this week are both breaking out with structure, volume, and narrative behind them. One in AI infrastructure, the other in crypto resurgence. Trade smart, manage risk, and don't chase. Plan your levels and stick to your system. If you found this breakdown helpful, hit that like button, subscribe, and drop a comment below. What are your top plays for the week? This is the Weekly Spread, and I'll see you next Monday.